I'm seeing a merge of both industries. And so the report that we were writing as BCG, we had 4 different scenarios how we see a merge of traditional finance and blockchain native companies. Yeah? And we see over time a convergence of both, meaning that some topics of the crypto world are looked into from the traditional side, and also some traditional banking topics are going into the field of blockchain native companies. We see this, some big exchanges are offering now banking products, whereas traditional banks looking into stablecoins, tokenized deposits, tokenized money market funds, and so on and so on. So how I would see it now, out of these 4 scenarios that we outlined in the paper, I would bet personally on the scenario that we have a 2-lane approach.
Welcome everyone to Beyond the Cosmoverse. I am your host, Roberto Cassa, Marketing Director at Cosmoverse. And Cosmoverse is a digital asset summit coming to Hong Kong in 2026 during the Hong Kong FinTech Week, focusing on connecting infrastructure with institutions. Today's conversation, we have one of the most credible voices at the intersection of what is happening in the transformation of financial infrastructure to the digital rails. The individual that is coming today as a guest sits exactly in those conversations with banks, regulators, not about being on chain, but deciding to operate on chain. It is my pleasure to welcome Dr. Bernhard Kronfellner, partner and associate director at Boston Consulting Group. Welcome, Bernhard.
Thanks for having me.
You are one of the most credible individual to speak on what is the outlook that is happening in the next 2-3 years in terms of institution moving to the on-chain rails. And before going there, I actually want to roll back to your background, because your background precisely is into mathematics, quantitative finance at JP Morgan. And this is something that I think can give you a different perspective. So I kind of want to ask you, what did you learn specifically by studying mathematics that actually help you in your today's work, and where the shift exactly happened?
And so my studies that I studied mathematics, but also I studied business on 2 different universities. So one on technical university, I studied mathematics, and then business university business, and then I got my PhD in math. But I was always, let's say, focusing on to become a quant on Wall Street, so to say, so to become a quantitative engineer and a financial engineer for the banks. And that's also where I started my first career at JP Morgan 20 years back. And how does it help me now with my current work? Since we are helping on the technical sides banks with digital assets, that's definitely helpful, because I was working for banks. So also before working for BCG for digital assets, I was consulting banks for 10 to 15 years on the technical side, as someone who puts the strings together to basically the fuel between the software, and to understand, okay, where's the risks, what kind of tech is missing. And that brought me quite early into cryptocurrencies, because cryptographics is a very old mathematical concept that I was also studying 20 years back. And now with this new innovation of digital assets, all comes together. And it's a pleasure already over the last, let's say, 7-8 years that I helped banks, but also regulators that are regulating banks, to get into this new field of digital assets, blockchain, and cryptographic methods in a broader sense.
Also wanted to ask you, when was that precise moment, like the year that at Boston Consulting Group you started to focus precisely on blockchain?
I mean, I wrote the first slide, I would say 2017, for a presentation for BCG. Back in the days, I got a lot of headwinds for the topic, because it was very new. It wasn't our core kind of business. And everyone was telling me, no, we will never sell a project on this topic, and our normal clients are not waiting for this topic. But, I continued writing slides on the topic, and then 2018, 2018-19, we got our first digital asset project. And then we had 1, 2, 3 a year. And then by now it's a big industry for BCG. So at the moment we have 10 different cases, 15 different cases running on the topic globally. And again, it's now a practice for BCG and a big industry for us.
Yeah, that's actually what I was hoping to hear, because that add a lot of layer to the story, because being in one organization that was very focused on traditional finance, and being one of the first to actually push towards the adoption of blockchain that in 2017 was definitely in a very early moment, also with the first retail wave. Definitely paint the picture of understanding where the market is going well ahead compared to most of the organizations. And coming back to the present, the argument that is most popular at the moment is tokenization. And in particular with Ripple, one of the reports that you have been participating find a precise number, a prediction in terms of tokenized asset and tokenized market of 18.9 trillions by 2033. Now, those are precise numbers, especially now knowing your background in mathematics, that makes sense. But why do you see where that specific number came from? What is the analysis behind?
So the number was an average number. So we were calculating the number in various scenarios. So since it's an average, so we see even one scenario that is even more aggressive than this, but basically up to even higher trillions might be tokenized. Where this is coming from is especially that the belief that maybe some asset classes are picking up even further the tokenization method, like real estate or intra-banking treasury, like money market funds and others, or securities or equities. So it's those tokenization of asset classes very often comes in waves. Yeah? So for instance, we are seeing now a wave of repo market that sits more and more on-chain, not completely in a tokenized version, but record-keeping on-chain, so to say. And so it comes asset class per asset class, and if one of those big asset classes, again, like real estates then or equities, then this number might be even bigger than this 18 trillions. But of course, there's also a scenario where we see a smaller adoption. This could happen if we see another FTX happening, or if we see a bear market that is not only in the retail market, but also, let's say, a bear market in the institutional adoption, what we are seeing now, because we have now a bear market of the retail market and trading activities, but we see definitely a bull market when it comes to institutional adoption of the technology. So again, this is 18 trillions that we calculated together with Ripple is an average number out of many scenarios, and it's hard to calculate, of course, but it definitely follows the belief that it's asset class per asset class.
Yes, and I was speaking in one of the prior episodes with Anina Milanovic, which is strategic advisor at the World Bank, and she see tokenized deposit like one of the first assets to actually drive the tokenization wave that could help and facilitate the number that you have shared, but also something that you specifically said about the FTX crash. And I did my research, and BCG did a report on tokenization right after what happened to FTX, which was a moment where the market was taking distance from the blockchain industry and the crypto sector. And that was specifically about tokenization and the structural case that tokenization is independent from the crypto market cycle. So why specifically that? Is it because tokenization is not necessarily for crypto and the project, but primarily for traditional finance, banks and institutions?
Yes and no. If you would have asked me, let's say 5 years ago from now, I would have bet that tokenization would be largely used for retail clients to tokenize kind of everything from collectibles to, even NFT. Even a real estate is an NFT, so to say, yeah, because it's non-fungible, yeah. So I would have bet that the first.
I remember that at Cosmoverse you also mentioned Pokemon cards.
Yeah, exactly. Yeah. So I would have bet that it will be, let's say, for retail. But now it seems that especially for institutional clients, we see the highest adoption rates of tokenization in general. We see, for instance, you mentioned tokenized deposits. I would also say that tokenized money, so to say, in the form of stablecoins is something where we see already a very high adoption, and this will pick up further, especially when the big consortiums of Kivalis, for instance, in Europe, or the US dollar consortium around the big investment banks will issue their stablecoin very soon, that we see even much higher adoption rate of tokenized money, so to say. Tokenized deposits at the moment is quite small, but it also has a case, especially when it comes to pay interest rates to the liquidity giver in the first place, but still use the money on the balance sheet to move around. But also we see lately, for the last months, I would say, a high increase of tokenized treasury activities and tokenized repos on Canton Network, but also on Kinexys. So coming back to your question, now it seems that the institutions are exploring the infrastructure of blockchains for their problems that they have and that they had already for the last years, and found a good solution for it, whereas the retail market, for what it was initially kind of set up, to have a 24/7 trading and a fractionalization of ownership and so on and so on, is a little bit, not lagging behind, but it didn't pick up that tremendously like for the big institutions.
I would say that the market right now, when it comes to crypto native, is particularly challenging because we are seeing a broader wave of project winding down, especially because there isn't the liquidity that there was before in the market. At the same time, as you mentioned, we are seeing this institutional wave looking at operate on chain. So this is a question that is probably going to give a bit of anxiety to our audience that I want to ask you right now, which is, from what you're seeing from your clients, do you actually see our industry, the crypto industry, transforming and increasingly becoming actually, how can I say, institutions replacing the crypto natives, and some sort of this startups wave that we had in crypto actually dying down? Or maybe do you see a comeback into a new startup wave in crypto once maybe the regulation is in place, some financial institutions start to operate on chain?
So at the moment, I'm seeing actually a merge of both industries that you mentioned. I mean, the institutions found this topic, this infrastructure innovation to solve some of their problems, what I just mentioned before. And on the other side, also, let's say the crypto industry that was highly driven by, young companies. I wouldn't say it's startups because many of them are very big already. They are becoming more professional, more institutional in a way. So it's more that both are merging from both sides in order to use this new technology for solving some problems that are in finance already for years.
Some of the crypto natives that are now becoming more institutional can actually provide services or infrastructure to institutions that facilitate kind of the adoption of institutional players. If that's the case, I think that one of the main resources that you are a co-author is the report The Future is on Chain with EBM, which I found very interesting, especially also for my field. It paints a clear picture and multiple scenarios of where the industry is going. And I wanted to ask you if you can share some insight in those scenarios in the report, which is on-chain bank of the future, open internet money, two-lane and marginal change. And between these scenarios, which one do you think is the most likely to play out?
So the report that we were writing as BCG with especially Dfns, so the Dfns, the wallet provider, and IBM, we had 4 different scenarios how we see a merge of traditional finance and, let's say, blockchain native companies. Yeah? And we basically see over time a convergence of both, meaning that some topics of the crypto world are looked into from the traditional side, and also some traditional banking topics are going into the field of blockchain native companies. I mean, we see this that, I don't know, some big exchanges are offering now banking products, credit cards, and so on. So directly moving into banking, whereas traditional banks are looking into stablecoins, tokenized deposits, tokenized money market funds, and so on and so on. So we see already that we start with a kind of an overlap of those topics, and we have a convergence from both sides. So how I would see it now, out of these 4 scenarios that we outlined in the paper, I would bet personally on the scenario that we have a 2-lane approach, which basically means that banks, but also crypto players, so basically from both sides, would need to have traditional rails, but also new rails. Now comes, of course, the question, is this now more expensive to have, let's say, both worlds implemented in one company? Well, yes and no. I would say normally yes, if you need to have a parallel run, that's always more cost intensive. But no, because many of those new crypto products are cheaper. Yeah, so the more volume you move over, for instance, to treasury products on chain, where you have a settlement of t plus 0, so in the next 5 to 7 minutes, and not in t plus 1, where you pay the entire day interest rates for your buffers, or where you cannot get interest rates when you have too much money and want to get interest rates from the market. So this one day is a lot of money, and this one day that you can settle earlier will basically justify this parallel run. Yeah. So at the end, even though it's more cost intensive to have a parallel run, if you move over the volume to the new lanes, then you're directly more cheaper. And then gradually over time, I would expect that in some product dimensions, you would only shift over to blockchain, whereas in other dimensions or other products, you might stay where you are. Yeah. Might say where you are in a way that you stick to the traditional banking rails.
No, so this is a optimistic vision also for the crypto natives, because it's more going towards a convergence rather than competing between these two realities. Within the report, I took some notes of some number that I found very interesting, which is there is a prediction for tokenized money market funds to be 600 billion by 2030, and P2P on-chain transfer are considered 90% cheaper compared to the current rails that banks are using, for example. And 90% of enterprises are currently evaluating blockchain initiative. So pretty much most of the market, 90%, it's quite a big number, is considering blockchain initiative in a year that almost from my retail side, the blockchain industry seems dead. So this is quite an important contract. And I wanted to ask you, from the conversation you are having with institutions, are they looking to build their own digital asset platform, or are they looking mostly for a provider?
Depends on the size. So the bigger the company, the higher the likelihood that they want to build something themselves. But still, very often the answer is that they're looking for vendors that are helping them in the market. Or what also I've seen is that they start with option 2, that you just mentioned. Basically get a vendor from the market, learn along the way, and then gradually take over one or the other services to not a buy version, but rather to a build version where they build it themselves, but gradually over time. But again, it depends on the size, it depends on the bank, and this is very often what we do as BCG to help some clients, banks or large institutions. Should they rather, in order to enter to the game, or should they rather build it themselves, or buy something, or partner with something, or buy a startup that has the capabilities and the teams, and then how to do that then. So this is so it depends. That's the quick answer.
Also, another perspective that I think you can add to, which is very valuable, because right now we are speaking primarily of the private sector, but there is also the public sector in play, and from a regulatory side, actually, that's the one that is currently enabling all these institutions to start this transformation. And you are an advisor both for the Austrian and the Qatar regulators. From those conversations, what you're seeing, how advanced is the move towards adopting digital asset framework? And of course, there is a big contrast, because the Middle East has been more advanced in adopting digital asset, while Europe has a regulation which has more constraint with MiCA, so maybe the Austrian approach is slightly different. What is the difference that you see in the market in this case?
So Middle East doesn't equal Middle East. It depends where you look. Your comment made sense for Abu Dhabi and Dubai, but Qatar is definitely a different player, and they're very selectively choosing their products and their topics that they're integrating, especially around tokenization of, let's say, oil and gas, or a little bit of real estate at the moment and so on. So it's they're more selective in that this open sea approach. Qatar, a little bit less, but especially UAE, especially Dubai and Abu Dhabi, they are in the forefront of, let's say, adopting new innovative business models, and they have also a very, let's say, open approach in the regulation. But Europe with MiCA is also, well positioned. Of course, there are some not touched areas in MiCA, but that's why we will probably see soon a MiCA 2 around DeFi and many other topics and how to regulate this. But I always say it's better to have a regulation than to have no regulation at all, because you need to have clarity as a entrepreneur or as a company where to go and what to do in this specific jurisdiction. And therefore it's more helpful to have a regulation. Then it's the question how open it is and what you allow, what you don't allow. But in any case, a regulation is always better than have no regulation where it sticks in the gray area.
And I'm sure that also with the digital euro coming, there is a broader transformation happening in Europe, especially because the Europe Central Bank looking at making the digital euro a core settlement in the Europe environment, also to gain more sovereignty from external market. And in this, basically all the market across the world right now, all the regulators are kind of accelerating towards making digital asset framework. In the report that we mentioned before, there is also UAE and Hong Kong seeing as front runners in this run for digital asset framework. My question is, from your insight, is which market do you see right now having, I'm gonna say, an advantage over other, if this is something that you can share?
It's hard to pick one. I mean, first of all, we are supporting the World Economic Forum on a 1.5 years journey where we exactly do this to compare the various jurisdictions and where to go with what topic and basically move the global regulation together with all the regulators. So it's hard for me now to share some insights in this work. But I can say that we will issue and publish a paper with the World Economic Forum and various of the regulators in Davos at the World Economic Forum 2027. It will be a long report exactly on this, on the question of global digital asset regulation. Currently, we are seeing that there are, let's say, 8 different archetypes of nations. So let's say an archetype that is more the open sea approach. Everyone can come, and they have some principle-based rules, where you have then as well an archetype that is more on the consumer protection side, like Europe. You have another archetype that is, let's say, more a haven for new innovations, like some Caribbean countries and so on. So basically, you have 8 different archetypes, and it still depends on what you want to do. If you have to pick, so first you need to decide what you want to do, and then you pick according to the product and the market entry and approach your best jurisdiction.
This is very fascinating to hear, because this is exactly one of the gaps that I've been seeing also with other conversation, because right now institutions that are looking to operate on chain, to adopt digital asset, most of these institutions operate globally, so pretty much every jurisdiction has different rules right now, and navigating these rules has its set of challenges, especially if you want to operate globally. And on the other side, probably stablecoins have been the key driver to actually gain the attention of institutions across the world. You have contributed with BCG a 5 test for stablecoins to basically verify the various aspects of our stablecoins is secure for adoption, for broader adoption. Can you describe these 5 tests?
Should you have now a stablecoin as a bank, or should you rather have tokenized deposits, or should you rather join a consortium? Should you rather go a little bit further into payment first before you do that, or should you rather focus on the traditional rails? And it's very much centered around your client base, what your clients are doing in the way of international remittances, in how advanced your systems are at the moment, also in a way where to see your bank in the future, and last but not least, also from in which country you are, because in many countries you have stablecoin as well, a use case in a way that you have store of value and less on remittances. So it's again, as I said before, with the other topic of tokenization, also here with stablecoins, should you have a stablecoin, yes or no? It strongly depends who you are, what you do. So again, it depends again.
With this framework, do you also made examples of which stablecoins that are currently on the market that are more reliable?
No, we didn't. I mean, in the past, we only had Circle and Theta as the big ones, and with some small exception of Ripple offer the stablecoin, or PayPal then and so on. But as you know, now the answer of most of the banks is that they will issue soon their own stablecoin, like in Europe with Kivalis, and also in US with the big consortium of investment banks. You also have, of course, CPN of Circle Private Network and others, but I would rather see that those consortium approaches are very successful. I expect that we have stablecoins at the end of the year from those consortiums, or maybe even in Q3, Q4. They will issue the first stablecoins, and depending on how they push it into the market with their existing retail and corporate and wholesale network that those banking consortiums have, I expect that there will be a significant adoption as soon as they will issue the stablecoins.
Okay. I want to ask you now something that you have mentioned a few months ago, which connects directly with the conversation I had the past week with David Palmer from Vodafone, because he mentioned that he sees 100 billion AI agents by 2030, and he sees those AI agents as the next user base. So no longer humans as a user, but AI agent as a user. And on your side, you mentioned that one of the primary user of stablecoins might be AI agents. I'm curious if you can expand a bit more on the view that AI agents will be one of the primary user of stablecoin.
The blockchain industry and stablecoin will be in the midterm or long-term future highly used from agents. But I mean, we see some agents already that are out there and that are taking over some tasks from us. But I still will see a time of, like, let's say 5 years, 6 years, that our own personal agents will take decisions for what we buy and what we do without asking us. So this is not tomorrow. This takes some time, but it will definitely come. That's my bet as well. And as a crypto or stablecoin provider or a tokenizer or what have you, or anyone in finance or in any type of industry, it makes totally sense to build your product already around the possibility to integrate easily agents into your offering, and also that agents are finding your offering compared to other offerings. So it will be, it's a little bit like Google nowadays. Now you're building your web page, you're building your offering in a way that that Google finds it quicker, or you even pay Google that you are ranked higher in Google search for specific words. And same we will see with agents in the future. And so all companies, not only in the financial industry, but really all companies should start building for agents to be found as well, and not only for human beings to go to Google and find your offering.
Especially because many enterprises are actually looking at implement AI agent into autonomous systems. So I can totally see that there is a demand for building an infrastructure that has AI agents into the picture, because those are definitely going to be probably the biggest user base humanity has ever seen in its history. We're suddenly speaking about innovations that are happening. And one innovation was also the metaverse. You had a focus in the metaverse in the past. We saw, for example, Meta, one of the tech giant, kind of losing the focus on the metaverse and stepping away. What the digital asset market can learn from what happened to the metaverse? What we can learn from a sector like the metaverse that has been pretty much losing interest across institutions?
It's hard to say, because it is an adjacent topic to many of those offerings, but it's for many people still a little bit in a play area, the entire goggles and the device of Apple and then others. I believe that it will come when the technology is there. And again, we see already some signs of Meta Ray-Ban glasses and others, that we might see additional offerings, not only from the hardware side, but also on the software side. And as always, you need to have the hardware first in order to motivate startups and funds and money across the globe to put money on the table and entrepreneurs on the table to build for those hardware devices. It will definitely come, but only if we see hardware that is as smooth as normal glasses. I believe that there will be a big market also in combination with the agents, because then I can communicate with my agents that might sit around the small device, seeing everything, and I can then ask my agent, hey, where is my gate? And then my agent communicates via my phone or directly to the glasses and gives me, in an XR kind of way, the instructions, okay, straight here and then right, that I can follow then easily. But again, I think we are tech-wise and hardware-wise not there yet, but this will definitely be the future. Good example is emails versus WhatsApp versus writing letters versus and so on. Yeah, so letters were here for years, for decades and centuries, but still, I'm still receiving letters sometimes. Yeah, and for other topics, you write emails, and for other topics and so on. So it will be a convergence over years that you see, okay, a little bit more of this and maybe less of other use cases. And like with letters, emails, WhatsApp, and other messaging devices, for something, it's still appropriate to write a letter. And for other things, it's more appropriate to write a WhatsApp, and for other an email and so on. So we'll get this feeling for what is appropriate to use then. And maybe in the future, for some use cases, we will use then our glasses with the software. And for other use cases, we might stick to the traditional way of doing things, like we use letters now as well for, let's say, more administrative stuff with the government or whatever.
I mean, there could be even an increase of adoption of the old methods like letters, since I don't think we are kind of prepared for the emergence of deepfakes with AI that could impact various systems. So we might see letters getting traction again, who knows? But I totally get what you're saying when it comes to the metaverse, that in that case it was too much ahead compared to where the market was and where the technology was. While right now, when it comes to digital asset, we are actually pretty much already have a mature market also from a regulation standpoint. And this is why there is this broader digital transformation across financial infrastructure happening right now. I want to ask you a question which falls more towards the younger generation, because you lecture to universities in Austria. And my question is, are you already speaking with students about digital asset? Is it a topic that you find relevant to share?
Yeah, definitely. Definitely. I mean, you only need to look at the adoption rates that you see of digital assets globally, and it must be in classes, especially around finance. I mean, it doesn't have to be in every class, yeah? But when it's about the new financial professional that we are educating in university, it definitely has to play a role. And I would say, especially the new technologies must be represented in class, maybe even higher than the traditional ones, because on the market we have already a lot of experts and professionalists on, let's say, traditional topics, traditional treasury or capital markets or what have you, that we're learning it already for years. But let's say on blockchain topics or on AI in finance or in how we could use XR for new or other innovations for industries like finance, banking, private equity, venture capital, and so on. Yeah, even further, needs to the younger generation to be educated accordingly, because they have the time at university. They are dedicating 5 years of their life, yeah, to learn those things that they will probably need in the future. And again, why should they learn something that the industry knows already inside out, and where they're kind of even lagging behind when they start in the job market? So they should rather learn something where they're spot on the new trends, on the others doesn't know the topic yet that much. Yeah, so it must be definitely in any finance or financial engineering or class, or also IT class or innovation class in university.
I definitely think that the younger generation right now have a very important chance, which is they are at the beginning of a complete digital transformation of the financial sector that, especially thanks to the conversation today, we know it is happening, and all financial institutions are pretty much into the conversation. Regulators are shaping digital asset framework. So I really want to thank you, Bernard, for sharing your insight today, because I think that now there is actually a clearer picture of where the market is going, an insight that can help all the operators listening to this podcast to adapt to the digital transformation.
Thanks for having me, and it was a pleasure to talk to you, and I hope I could shed some light into how I see the innovation, and how, not only institutions or banks, but also universities should react and act accordingly.